The world of investing can be a scary place. Sure, investing may be an excellent way to build your wealth, but if you're just starting out, it's easy to fall into some traps that could cost you money. Even while falling into one of these traps is unlikely to be catastrophic, it can substantially harm one's wealth, prevent one from accomplishing financial goals, and affect one's self-esteem. We have seen several traps that investors could fall into and the damage they can do with returns. Here are 7 of the most common ones you should avoid. Number 1. Superiority trap. Commonly termed as the overconfidence trap. Investors who are stuck in the superior point of view have exaggerated ideas of who they are. These individuals have excessive self-confidence and believe they are more knowledgeable than industry professionals as well as the market. Even if you have a good education, you may always use a few pointers now and then. Many investors have lost a ton of money because they believed they were better than everybody else, and these are typically the same people who fall into the common investment traps. They have an excessive amount of faith in their investments and abilities, and as a result, they could even disregard sound advice that might prevent them from making wise decisions. An investor could behave recklessly and take a losing position on the grounds that they believe they're more knowledgeable than the market. The investor believes that someday the market will recognize the value proposition of the company and drive it higher. You risk not putting in place the necessary precautions to preserve your investment capital if you have excessive confidence in the investments you're making. You can wind up making bad choices and taking on unnecessary risks, which will only lead to losses. Number 2, FOMO. This stands for fear of missing out. It is strongly related to the sheep mentality since it encourages people to act without thinking. The term sheep mentality describes a person's tendency to mimic and follow other people, in this context, other investors. Instead of using their own independent thinking to guide them, they are mostly guided by instinct and emotion. Investors who fall into this trap frequently worry that they're missing out on a potentially profitable opportunity. Following the herd makes them feel a lot better and more at peace rather than left out. In order to avoid being the only ones left behind, people feel safe exiting the market if everyone else is. Don't rush into following others' lead without conducting your own research first. Before selecting whether or not to invest, carefully evaluate the investment and examine the fundamentals of the company. Number 3, anchoring trap. An excessive dependence on one's initial thoughts is referred to as anchoring. It entails stubbornly clinging to the notion of an asset's original value to the point that it leads one to make poor choices. For instance, you might believe that a particular business is thriving and that investing in its stocks is a smart move, but this assumption could be wrong in the near or far future. The same thing happens when an investor keeps a stock for far too long as they are anchored on the higher price than the stock was originally purchased for, while in reality, the stock should have been sold long ago. One must keep an open mind, be attentive to new sources of data in order to avoid falling into this trap, and realize that just because a company is doing well now doesn't automatically imply they'll remain on top tomorrow. In any event, bear in mind that there is never a guarantee that an investment will perform well in the future. Simply because a stock performed well before doesn't guarantee that it will do so going forward. Investigate the asset's price history to gain a better understanding of how it has historically performed. Even if it may not quite match what you previously learned about the stock, be open to learning new investment information. Number 4, confirmation trap. When someone searches for and notices other investors or assets that support their present opinions, they fall into a confirmation trap. It might also happen if investors keep taking advice from people who have made the same mistakes before and are still doing so. In an effort to choose wisely this time, individuals will occasionally ask these people for help. Try reaching out to new sources who can provide you with good advice on potential investment opportunities rather than listening to someone who provided you lousy advice. Investors may unintentionally seek for or favor information when studying an investment that confirms their pre-existing assumptions about the asset or strategy and fail to address information that challenges those notions. Investors end up with a biased perspective, which leads to bad choices. Confirmation bias that contributes to investor overconfidence explains why they don't always act reasonably and may support claims that the behavior of the market is ineffective. Knowing that confirmation bias exists would be the first step towards conquering it. They should look for opposing viewpoints that contradict their perspective after acquiring evidence that affirms their beliefs and opinions. Simply put, be open-minded. Number 5. Sunk cost trap. This entails defending the choices or actions you have made in the past, which are frequently damaging to your assets. This results from refusing to acknowledge that you made the poor decision that cost you money. You may also describe it as a person's tendency to continue with an endeavor that falls short of their expectations, mostly because they've already invested money or time. Similar to anchoring, this entails holding on to stocks in the anticipation that the price would rise back to its original value. In this instance, the investor is justifying their choice to purchase and hold to that specific stock, which could have a negative impact on their portfolio. The wisest course of action would be to look for something else with better potential if your investment isn't doing well or is sinking fast. You must accept defeat or the reality that you made a mistake, no matter how difficult it may be. If your investment doesn't work out as you had hoped, make a change before the asset's value drops even further. Avoid developing any emotional attachments to your investments. Setting investment goals is the greatest approach to stay out of this trap. Investors may establish performance goals for their portfolios, and if they weren't met, they could reassess them to see where they could be improved to generate higher returns. Number 6. Pseudocertainty trap. The term, also used to refer to loss aversion, explains how an investor views risk. Investors limit their risk exposure when they believe their investment returns will be favorable, yet when they anticipate a loss, they will extend their reach and take greater risks. They are prepared to raise their stakes in order to recover capital, but not in order to generate more. When the possibility of losing money outweighs any chance of making money from an investment, loss aversion may be present. It typically happens when an investor is unwilling to take chances in order to avoid losing money. Investing always carries some risk, and some investments carry more risk than others. Loss aversion prevents you from taking advantage of opportunities to profit since you are concerned about losing your investment money. Without a doubt, taking on too much risk can lead to a disaster, but so can taking on too little. Create a strong financial plan and don't let emotions influence your choices. Give yourself permission to feel a bit uneasy. Make smart investment decisions by selecting assets with a proven track record. Number 7. Irrational exuberance trap. Also known as overconfidence bias, is a tendency to have an inaccurate and deceptive opinion of our knowledge and abilities. It is, in essence, the notion that one is superior to what they truly are. In many situations, confidence is seen as an asset, but when it comes to investing, it's more of a liability. Investors frequently assume that the past and future are equal, as if there were no room for unpredictability in the market. It is almost certain that what has happened in the past will most likely occur again. There will constantly be highs and lows, which will cause assets that were previously successful to lose their sparkle. Investor overconfidence usually leads to greed and pushes the market to the point where a significant correction is unavoidable. If you are new to the investing world, you might want to consider working with an expert who can develop a smart investment strategy that will maximize returns while minimizing risk. There are numerous specialists available to assist you along your journey, so you don't have to rely solely on yourself. The reality is that investing comes at a cost, but if you fall into one of these investment traps, you can be even more in danger. See what works for you by conducting your own research ahead of time. By using a few of these suggestions, you can prevent wasting time and money. That concludes today's video, which we hope you enjoyed and learned something from. If you liked this video, don't forget to give it a thumbs up and subscribe to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.